Okay, good evening, everybody. Welcome to this special webinar. We are here to discuss a topic of strategy in investment planning. I thank Thane Municipal Corporation and Thane Smart City Limited for giving me an opportunity to speak on the platform DigiThane. My name is Ankit Savla. I am a certified financial planner. I am the owner of the company name as HiFinance. I'm a co-founder of that. At HiFinance, we do financial planning and financial coaching to our clients. Today, I am here to discuss some of the important areas regarding the investment, what common mistakes investor does, how to overcome those challenges. There are two type of people in our society called as distributors and advisors. How do we differentiate between them? The reason for investment should not only be the tax saving, and over and above that, how do we help ourselves to avoid falling in a debt trap, and few more investment ideas that would be discussed in brief. So let's start with few of the mistakes so that we discuss about them and then we discuss the approaches to overcome them. I have met almost nearly 300 plus families in this last 1.5 year of my advisory. And one of the common point that I have noticed among people is they invest, but they do not have a financial goal attached to it. They invest because someone has suggested it. Whether that investment asset is suitable to them, not suitable to them, is not checked. Only the returns is checked or the benefits of the scheme. Not even we check about whether there is a right liquidity or not. So how to overcome these challenges? So there are two approaches. A normal middle class or upper middle class family can have a set of financial goals with them. With the help of financial goals, they can approach a right planner. For example, like I have a son, a 3 year old. I want to plan for his children's education, higher education at the age of 18. So now if the corpus is required maybe 15 to 20 lakhs as per the present cost, I would, with the help of an advisor, I would try to calculate the inflation adjusted corpus and then plan what is the minimum monthly investment or a yearly investment required to achieve a goal. By this, I have a clarity what is my investment tenure. So what can be my risk profile as per the tenure that is there for the investment. And this helps us a lot when there are negative bearish market cycles well, how should we be invested, because with the behavioral finance that is noticed, people invest more in the bull run and redeem all the money that they have in the bearish run. So bearish run is basically an opportunity and these cycles keep coming up. So when you have a defined goal and a defined tenure and you have the right asset allocation, we can avoid having those mistakes and we can build a wealth creation. Second approach is a TLU approach. The TLE approach is more for an upper middle class HNI clients, wherein they have a set of corpus and they do not have a defined goal because they have already achieved all their basics goals like retirement planning, children's higher education, or buying a home or a car. So over and above that, they have a lot of excess wealth. Now with this excess wealth, they keep investing looking at the returns. Now the first aim should be to protect the capital that they have generated, and over and above that, first aim should be to, the second aim has to be to get an inflation adjusted return first, and after that we look for some alpha generation in the portfolio of 2 or 3%, so somewhere 9% on a complete portfolio. That looks as a good return on a wealth. So we calculate on the basis of three parameters. We call it as TLU. T stands for tenure, L stands for liquidity, U stands for unique constraint. Like if you need, you do not want to be invested in some kind of businesses like alcohol or meat, or you want some money after every 3 years, or you want a cash flow after every 1 year. So looking at your liquidity, your tenure, we plan what has to be the right asset allocation, and we do the asset allocation as for that. So the next point is, how do we differentiate between these advisors and a distributor? An advisor would always start his explanation with a list of your financial goals, your liabilities, so that he can first help you to come out of the debt trap and then help you to plan your financial goal. A distributor normally would start with the product, share the benefits of the products, the return. So whether that is suitable or in line with your goal, is not been calculated, and we just end up investing. Maybe after 2 3 years, when we find no, this is not a suitable product, we cannot just at times surrender, because these are all traditional products or the market linked ULIP products, wherein we have to face the loss because there is no liquidity. So you when you get in play when you get in touch with an advisor, he'll always ask about the list of your financial goals. He'll prepare a comprehensive financial plan. He would do a right allocation. He'll not only go beyond chasing returns in your portfolio, he'll ask for the right tenure. So suppose a tenure is between 0 to 3 years, he will always prefer having debt funds. If the tenure is up to 5 years, it would be a mixture of maybe 70/30 or 60/40 of large cap equities and a debt fund. If the horizon is up to 7 years above, he can opt for a multi-cap category funds. And over and above, like 12 to 15 years, we can surely go for some mid caps and small caps. Again, all have to be a part of portfolio, and portfolio cannot be concentrated on the one side. Oh, and the other part, when we have met families, we look at the asset category. So assets are more into the non-financial parts, that are gold, real estate, whereas the financial assets, which are liquidable, are only 20 to 25% of the portfolio. So I advise families to have a uh, liquid portfolio of nearly 50%. In that can include cash or cash equivalent fund, FDs, mutual fund, stocks. PPF after 7 years is partially liquidable, and such kind of product. A real estate in Mumbai or around has been really noted that there is only a 3% of rental yield. So suppose a property worth 1 crore can only maximum earn you a rent of 3 lakh rupees, whereas a saving account earns you somewhere between 3.5 to 4, and a FD earns up to 7%. So people who are heavily invested in real estate other than the consumption should need to get in touch with an advisor and check the complete weightage of all the assets in their portfolio, which help them to rebalance their portfolio and generate again a good alpha along with the liquidity. Coming to one of the important part, that is insurance. Normally we invest in a traditional product and say okay, we are invested in insurance. Insurance is not an asset to be invested, it is purely for the risk coverage. So we should buy only pure insurance product and not be invested in that, because till today in market, whatever the investment products are available through insurance are non-liquidable. Even after 5 years, you have some tax free tax-free redemptions in the ULIPs, but you end up paying surrender charges, which even kills up the return that you have generated. So I advise people to have an adequate of term insurance, maybe from a private or a government subsidized companies like LIC, or the private players like HDFC, ICICI, Max, and many more to list those things. Along with that, people the working class salaried people rely on the health insurance provided by the employer. But they need to realize one thing: the day they complete with their journey of as an employee, and if they have some ailments, the insurance that they buy after the retirement or after the completion of their employee life, they will have to have the insurance with some exemptions. So it is good to buy an health insurance for yourself at the early age, and later on you can increase the sum assured as and when required. If still that is not possible, you can opt for some umbrella policies, which says that you have a deductible of 3 to 5 lakh rupees, and after which you will be covered. So even if you after your employment is completed, or there is a sudden termination in the recession days, maybe there is a medical expense up to 3 lakhs or 2 lakhs deductible, whatever is there, you would pay from your pocket, and the rest would be paid by the insurance company. And these insurance products are quite cheaper in market compared to the normal traditional health products. Also, we should have a different type of personal accident cover if required. So if the insurance is built well in the portfolio, all the investment done are protected, because against any liability that comes suddenly, we don't have to withdraw all the investment that we are doing. Coming to one of the important topic, like government scheme, people usually avoid investing in some government scheme like PPF, senior citizen saving schemes, sovereign gold bonds. So if you have a lot of gold, as a physical gold in your portfolio or through ETF, I suggest people to have a part of gold allocation through the sovereign gold bonds. Sovereign gold bonds are, again, as the name says, sovereign, it's from the government. You get 2.5% of interest on these bonds, and moreover, you buy it at a face value and sell it at the market value after 5 7 years during the maturity, and you have a tax free returns from that. So it's, and the income that you get, a 2.5%, is treated as an income and is taxable as per the tax bracket, but you still get some income from such bonds. And moreover, these are in a liquid form, so they paper form, so they do not have any impurity issues. Coming to one of the important schemes that a senior citizen should have, most of the retirees that we have met have been sold some unique product or the annuity product. If a senior citizen simply invest as a couple 30 lakh rupees in a senior citizen saving scheme, 15 on each side, they get a monthly income of 21,000 as per 8.3 or 8.4% interest rate, which is given to them quarterly. But if we count on a monthly basis, it becomes 21,000 rupees, which is actually a good sustainable amount for them. Then we come towards the PPF. PPF is always compared by the ELSS. Now we cannot compare both the categories, as one is a debt product and one is a equity linked product. Of course, equity linked product in the long run will have higher returns when compared to a debt product like PPF. So PPF and ELSS both has to be in portfolio as per the right allocation, as per the risk profile. So simple example, if a PPF, if a person investing in a PPF 1.5 lakh rupees every year, which is a maximum limit, he invests that for the next 15 years, he generates somewhere 44 lakh rupees. And if he just continues that amount without adding more amount for next two sessions of five years, he makes somewhere in decent amount of 95 lakh rupees in a span of somewhere 25 years. So young person of 30 age by 55 can make somewhere 95 lakhs through a right asset allocation of a PPF. Also, I have a one point to say, people invest mostly for tax saving purpose, and they wake up in the month of March or Feb when they have to submit the proof of investment under the ATC. So please kindly do not do such mistake. Investment is not only for tax planning or tax saving, it is for your achieving your financial goals. One of the example is, people invest, people have the home loans and the principal is treated as a deduction in ATC. So they try to avoid having investment in some government schemes like PPF. Now PPF is one of the debt product with a triple E. So if you have an exemption when you of tax when you invest, the interest is exempted, and even when you redeem that, there is a tax exemption. So you have to do a part of PPF even though you have completely exhausted your ATC through the principal of the loan. So coming to the loan part, when people take loan, they do not check the ratio of their income and the EMIs. So when you are planning for buying any debt for achieving your goal, make sure that EMI counts to around only 33% of your incomes, not going beyond that, because beyond that is danger line. So when you have 33% as paying as a EMI, 33% as a living expense, and maybe 33% as an investment for achieving your future goal, it's a more balanced portfolio. So if you think the loan to income ratio is higher than 0.33 or 0.35% of the total income, then make sure you delay such goals by maybe 3 years, 5 years, and invest in some suitable product which help you to make more of down payment. And by this time, by 3 to 5 years, you would have some increments in your incomes too. So by this, you can bring such ratios of debt to income down. Also, when I talk about insurance, I missed about one of the important concept. When any married person is buying a insurance, he should make sure that he adds a MWP Act on that insurance. By having this, he protects all the insurance money that is would be given to his wife. MWP protects the money that is given during the claim from any creditors, and there cannot be the money basically gets converted into a trust, and that is not attached to any creditor. If the person who had bought a policy had any credits when he died. One of the important thing that is nowadays buzz among the young people is I want to trade and earn quick money. So something very quick can go in both the direction, positive and negative. F&Os are mostly for hedging the portfolio and not for trading. So suppose you have bought some Infosys 1000 or 10,000 shares and you have an option standing across against it, you actually hedge your portfolio by buying that small insurance through an option part. Also, we see there are many trading classes going on in and around city wherein they teach you about trading and earn an income. So these are all technical parts. You utilize lot of your time, but if you go through a simple strategic allocation and if you have a right tenure, you can create a wealth rather than utilizing your more time and non concentrating on the mainstream income that you have been involved in. Also, I have an example for that. So if you are doing a trade for maybe a period of 10 years, every year you have a 25% CAGR on whatever you are doing for the next 7 years. And if the last 3 years, if goes by negative 25%, the whole transaction of 10 years only earns a 7%, which is just equivalent to an FD. So why not do a right suitable asset allocation between debt and equity and achieve the right things? Most one of the again topic today is we want to invest directly in few of the mutual fund where houses wherein SEBI has brought two categories. One is regular, one is direct. Yes, you can go direct, but you should have a right financial advisor or a coach to guide you. Otherwise, the third option is you learn about financial planning. There are small courses in the market wherein we teach you about the goal based planning, asset allocation. So you firstly and enhance your knowledge by learning all these calculations, approaches, asset allocations, and then do it yourself. Then that is the correct way. But just to save some part of the commission that is being given to an advisor, you try to avoid not having a professional to guide you. That would be really a big mistake there. And these are the some important point that I wanted to share with you. If also we do some wealth checkup camp in Maharashtra, so if anyone with a group of CFP, we have a panel with that. So if you are interested in such kind of events, we will surely broadcast through the same medium and you can participate by sharing your portfolios with us. We would guide you the changes required or how you can do it better if it is still a right one. And thank you for this.